Do you ever notice this? Every time the market gets chaotic, there's always one place where smart money quietly flows. And this time is no different. ETFs are becoming the new safe landing zone. But not every ETF deserves your trust. Let me show you what most American investors are missing. You know, after so many years working with US investors, from newly retired folks to those in their 70s still managing their own portfolios, I've learned something interesting. Most of them aren't looking for complexity. They want stability. They want steady income. They want the peace of mind that comes from knowing money is flowing into their account every week, every month, without having to sell the stocks they love. And then recently, a new name started showing up. QDTE, an ETF that pays weekly dividends with a yield close to 30% a year. Just hearing that is enough to make anyone interested in passive income stop and take a closer look. But to understand it, you have to look deeper. It's not just about the yield, not just the payout frequency, it's about how this ETF generates that income. And that's what I want to share with you today. Not a dry explanation, but the story of a strategy that has changed the way many people think about passive income from the stock market. QDTE, when the poor man's smart strategy becomes a 30% ETF. A friend of mine, a longtime investor, once told me, when you don't have enough money to buy 100 shares of QQQ, you can still think like the wealthy by using options. The poor man's covered call strategy sounds cheap, but it's actually incredibly smart. Instead of spending tens of thousands of dollars buying shares, you buy leaps, long-term, deep-in-the-money call options with a delta close to 1. Basically, they move almost exactly like QQQ, but at a fraction of the cost. That's the foundation of QDTE. This ETF doesn't own any NASDAQ 100 stocks. Instead, it holds multiple leaps as long-term anchors that track the index while minimizing the theta decay that destroys most amateur options traders. Interesting, right? An ETF that simulates owning the NASDAQ 100 using options instead of shares, and that frees up capital to do what truly generates the income. Selling zero DTE call options every single day. Zero DTE. When time runs out in a single day, if you've never traded zero DTE options, imagine this. It's a race between volatility and the clock. You have a few hours to make money before the contract expires the same day. QDTE sells these contracts daily, and it collects premium daily. That's the money pooled together and paid out to you every week. What impresses me most is how this strategy lets the ETF capture gap-up moves. You know how the US market sometimes jumps before the opening bell? Traditional covered call ETFs get stuck in 30-day call contracts. They can't enjoy those sudden moves. But QDTE is different. Because it doesn't hold calls overnight, it moves with the market whenever it gaps up. That's why QDTE sometimes outperforms QQQ, especially during periods of high volatility. But I want you to understand this. High income always comes with a cost. I want you to pause and really think about this. When has 30% annual return ever been free? Never. QDTE pays high income, but you must accept three trade-offs that I want you to truly understand. 1. Performance depends heavily on the fund manager's skill. This strategy requires precision. Every morning they must choose the right strikes under the right volatility conditions. It's almost like running a professional day trading operation. One bad day can erase an opportunity or a hedge. 2. Zero DTE premiums aren't always high. When the market trades sideways or drifts down slowly, the daily premiums may not be enough to offset the losses in the LEAPS. You'll see QDTE dropping exactly like QQU in many sessions. 3. The NAV is being eroded. This is the biggest concern. You may receive 20 to 30% dividends, but if the NAV drops by 10%, 15%, your real return isn't nearly as attractive as it seems. I once told a retired client, a high-yield ETF isn't always a good ETF. Sometimes it's just giving you your own money back. And that's absolutely possible with QDTE. So who is QDTE really for? If you ask me, here's what I'll tell you. QDTE is for investors who truly understand the strategy, who accept that this ETF will outperform when the market is volatile, underperform in long bull markets, and potentially see long-term NAV erosion if the fund managers don't execute perfectly. It's like a high-performance sports car, incredible in sharp turns, but not the best choice for long, straight highways. Final thoughts. I want you to remember this. Investing is not a race to find the highest yield. Investing is about finding what aligns with your goals. If you want consistent weekly income, understand the risks and accept that the NAV may decline over time. QDTE could be worth researching. But if you want long-term growth, stable, sustainable, proven, remember this: the market has always rewarded those who patiently hold real assets, not options that vanish day by day. Thank you for watching. If you found this breakdown helpful, leave a like and subscribe. I'm Hung Ha, and I'll see you in the next video where we dig deeper into ETFs, income strategies, and building lasting financial strength here in the US. See you in the next one.